So Bitcoin just flashed green. And, if you look at the timeline today, retail traders are already celebrating.
Oh, absolutely. They see that green and just jump in.
Right. It just bounced 2.5%, clawing its way back above that massive psychological barrier of $60,000.
Yeah, that's a big level for a lot of people.
It is. And when you see a green candle like that after weeks of bleeding, the natural instinct is to think, okay, the worst is over.
Right. The bottom is in.
Exactly. But behind the scenes, institutional desks are looking at what they call a hidden trapdoor. And according to the BTG desk notes that we are dissecting today, they believe the only thing that can actually save crypto right now is a traditional stock market crash.
Which sounds completely backwards, I know.
It really does. But welcome to today's deep dive. We are looking at a profound conflict between what the charts are doing today and what the macro environment is demanding for tomorrow.
Yeah, and we have a lot of data to get through.
We do. We are taking the BTG desk reads, layering in live OBV2 depth map data, and pulling macro reporting from CNBC, Reuters, CoinDesk, and Cointelegraph.
So a really comprehensive look.
Exactly. The goal here is to maintain a calm, professional trading desk tone to really figure out the mechanics of this bounce. Will the Federal Reserve actually rescue Bitcoin, or are they going to show up too late?
That's the real question.
Because honestly, treating this bounce like a comeback is like packing away your winter coat during a fall spring. We really need to check the thermometer first.
That is a perfect way to put it. Because, before we can even assess a fourth quarter rescue mission from the Fed, we need to look at the immediate reality of the tape.
Right. What's happening right now.
Exactly. We have to understand the mechanics of why an institutional desk looks at a green day and, still classifies the overarching structure as a confirmed downtrend.
Because of the structural damage, right?
Yes. It comes down to structural damage that a simple 2% bounce just cannot fix.
Okay, so let's set that tape right now so you listening at home have your bearings. I'm looking at Bitcoin trading right around $6,160. It's up roughly 2.5%.
Yeah, solid little move.
Bouncing off a daily low of 57,717 to be exact, and it hit a high of 60,474 before settling where we are now.
Right.
And hold on, looking at the broader board, it's not just Bitcoin moving. The Meiji altcoins came along for the ride.
They usually do.
Yeah, Ether is sitting near $1,619. Solana is up almost $5, trading at 77.
So the whole ecosystem is getting a lift.
Right. So with Solana up $5 and Bitcoin holding above 60K, aren't the bulls justified in celebrating here? Why is the desk treating every pop as a bull trap until proven otherwise?
Well, the optimism makes sense if you're only looking at a 24-hour window.
Just the daily chart.
Right. But the desk's conviction comes from zooming out and looking at the historical bedrock of the market. Let's talk about what happened in June.
Oh, man, June was rough.
It closed down roughly 21%.
Wow.
Yeah. In the context of Bitcoin's history, that is one of the ugliest monthly performances on record.
And it wasn't just the percentage drop.
No, the real structural blow happened last week when Bitcoin lost its 200-week moving average.
Okay, so for someone who doesn't spend their day plotting moving averages on a chart, let's explain the weight of that specific line. Why is losing the 200 weeks such a heavy blow to the market's architecture?
Because institutional algorithms and long-term macro investors treat that specific moving average as the ultimate floor.
Like a safety net.
Exactly.
Yeah.
Across multiple prior cycles, it has acted as that safety net. When price hits it, automated buying just steps in.
Right, the bots turn on.
Yeah. But when you break below that floor, those algorithms aren't just turning off. Some are literally flipping from buyers to sellers.
Oh, wow. So the whole dynamic flips.
The entire psychology of the market shifts from buying the dip to selling the rally. Both CoinDesk and Cointelegraph have reported on this recent price action, and, they're framing it as a steadying tape, but they are deliberately warning about critical support tests and more downside.
So the desk isn't just being arbitrarily pessimistic.
Not at all. They're calling this a downtrend because they are respecting the fact that the floor just caved in.
That makes the current bounce look incredibly fragile. And, if we want to know just how fragile it is, we can't just look at past chart lines.
Right. You need live data.
Exactly. We need to look at where the capital is deployed right this second. So we're looking at the live OBV2 depth map, which is essentially, an X-ray of the order book showing us exactly where real money is currently resting.
And just to clarify, we are strictly reporting the resting walls here, not the proprietary method itself.
Good clarification.
But the OBV2 data paints a pretty stark picture of the battlefield. Let's start with the ceiling, because there's this heavy, just suffocating layer of ask liquidity resting right above the current price.
So sell orders.
Yeah, sell orders densely stacked from $60,300 up to $61,000.
So anyone trying to buy this breakout is immediately running into a brick wall of institutional supply.
Exactly.
But, what happens if enough retail buying pressure somehow pushes through that initial wall?
Well, that is where the volatility really kicks in. Because resting inside and just above that supply zone are massive pools of short liquidations.
Traders betting against Bitcoin.
Right, using leverage.
Yeah.
If the price goes up, the exchange forces them to buy Bitcoin to close their losing bet.
Adding fuel to the fire.
Exactly. The depth map shows a $66 million pool of these short liquidations sitting near $60,600.
Oh.
And an even heavier $132 million pool around $61,400. If price spikes into those zones, that forced buying acts as momentary fuel.
It's a short squeeze.
Yep.
But the desk notes suggest this is just a distraction, right? Like a distraction from the real danger lurking below. So let's talk about the cushion holding us up and, more importantly, the trapdoor beneath it.
So the cushion is pretty thin. We have bid walls resting buy orders sitting from $59,900 down to $60,100.
Not a huge buffer.
No, not at all. If price slips through that, there's a secondary shelf of support sitting between $59,200 and $59,600.
But then we hit 59,000 flat. And looking at this data, that level isn't just a floor, it's a structural weakness.
It is a trapdoor.
Right. There is a massive $154 million pool of long liquidations resting exactly at 59,000. Looking at this like a frozen lake, it looks solid from above. But that $154 million trapdoor at 59,000 is thin ice. Step on it and you plunge straight through.
That analogy is spot on, because the initial drop to 59,000 isn't what destroys the portfolio. It's the avalanche of forced selling that follows when all those leveraged long positions are liquidated at once.
Right. The exchange just market sells their Bitcoin.
Exactly. Into an order book that we already know has thin support. So losing that 59,000 flat level literally pours gasoline on the fire.
It just accelerates everything.
It creates a liquidation cascade. It bypasses normal support levels, leading straight down to retest that 57,717 daily low.
Whoa.
And once momentum takes over, it drags the price toward a much larger macro magnet.
Wait, so if that $154 million safety net snaps, there is basically nothing underneath us to arrest the fall. Where does that momentum actually pull the price? What is the tactical magnet we are looking at?
The near-term tactical magnet is the $54,000 to $55,000 zone.
Okay, so quite a drop.
Yeah. The specific level drawing the market's gravity is the 300-week moving average, which currently sits right around $54,600.
54.6, got it.
And this level aligns with a broader historical support shelf that cascades all the way down to roughly $49,000.
So if 54,600 is the target, we need to unpack the psychology of what happens when we get there. The desk outlines a sequence they call the trap in miniature.
Right.
Walk us through how this plays out for the average retail trader who's just, watching their screen.
Well, it is designed to prey on hope. Here is the sequence. The liquidation cascade flushes price down into that $54,000 to $55,000 range.
Panic everywhere.
Total panic. Then the price hits that 300-week moving average magnet, finds algorithmic support, and bounces.
So we get a relief rally.
Yes. And because the drop was so violent, the bounce will be really aggressive. It'll look to most people like the definitive bottom.
Ah, I see. So the actual danger isn't the drop we just survived. It's the we're saved counter-trend rally that comes next.
Exactly. Because that relief rally is mathematically designed to stall.
It's a trap.
It typically runs out of buying momentum right below the 100 and 200 period moving averages. The price can't reclaim them, which means the overarching downtrend is still completely intact.
So they buy the rally and get crushed.
The hardest, most violent leg down in any bear market doesn't happen during the initial panic. It happens after the crowd is fooled into jumping back in, buying that relief rally.
They buy it, exhaust their capital, and then the trap springs shut. So if the chart is just this series of descending magnets and traps down to 54,600, what actually stops the bleeding?
That is the big question.
Right. And this brings us to the core paradox of today's deep dive. To find the real bottom, we have to pivot away from the charts entirely and look at the macro calendar, right? The Federal Reserve. And right now, the crowd is fundamentally misreading this.
The disconnect between what the crowd expects and what the desk is modeling is just massive. If you look at the macro reporting from Reuters and CNBC regarding the Fed's June dot plot, the official stance is highly hawkish.
Right, they want to keep tightening.
Exactly. The dot plot shows 9 committee members wanting another rate hike, and 5 of those members are penciling in not just one, but 2 50-basis-point hikes.
2 50-basis-point hikes. I mean, if you are a trader reading those headlines, you assume the Fed is your absolute enemy. That would suck an immense amount of liquidity out of the system. The crowd believes there is absolutely no rescue coming.
And the desk agrees that the Fed wants to be hawkish. But the bear thesis hinges on the idea that the Fed will be forced to pivot and cut rates in the fourth quarter.
Forced to.
Yes, forced. Not because inflation is magically solved, but because a falling stock market will force their hand right before the November midterms. The thesis specifically models a 20% drawdown in traditional equities to trigger this panic cut.
Okay, let's slow down and really clarify this paradox. Wait, so the bear thesis actually requires a stock market crash to save Bitcoin. That's a massive paradox. We need the broader market to break just so the Fed is forced to fix it.
It sounds totally counterintuitive that you need a crisis to trigger a rescue, but the desk relies on historical analogs that prove this is exactly how the Fed operates.
Give us an example.
Let's look at the year 2000. The Fed was aggressively hiking rates, pushing 50 basis points right into the absolute top of the market. They had no intention of stopping.
But then they did.
They were eventually forced to reverse course and initiate aggressive rate cuts. Why? Because equities finally broke and dropped 20%.
So the mechanism is reactive, not proactive. They hike until something structural in the traditional market snaps.
Exactly. And they did the exact same thing a few years later. 2007 is the other perfect analog.
The great financial crisis.
Right. The Fed was holding rates steady. We had an oil shock. We had early structural cracks showing in the subprime mortgage market. But the Fed refused to cut.
They just held the line.
They held steady until the equity markets entered a free fall. Once equities dropped roughly 20%, the systemic risk was just too high, and the Fed was forced into jumbo rate cuts.
Okay, so mapping those mechanisms to today's market, the S&P peaked around June 2nd. The NASDAQ hit its local top around June 3rd. If equities catch down to where Bitcoin already is, and we see that 20% flush, history dictates the Fed panics.
Right.
And that panic cut places the cycle bottom squarely in the fourth quarter, which ironically lines up perfectly with the crypto calendar.
It does. It perfectly aligns with the 4-year cycle clock.
Right, because Bitcoin topped in October, meaning a bottom lands late Q3 or Q4.
The synchronization is honestly compelling. But pragmatically, if we are waiting for a Q4 pivot triggered by a broader crash, we have to evaluate the collateral damage in the interim.
How low can we go in the meantime?
Exactly. We have to address how low Bitcoin can go while we wait for traditional equities to force the Fed's hand.
And this is where we really have to address the loudest, most extreme calls on the street, because when panic sets in, these extreme targets start dominating the conversation.
They always do.
Yeah. So we need to look at where those extreme targets come from, report them impartially, and then contrast them with the BTG desk's actual base case.
So the loudest bear models are entirely based on historical symmetry. They look at prior bear markets. Note that Bitcoin has historically drawn down 80 to 90% from its all-time highs.
With the last cycle dropping roughly 78%, right?
Correct. And they apply that exact math to the current peak.
Okay, let's put the actual numbers on those percentages just so you, the listener, know what the extremes are modeling. A 70% drawdown from the highs puts Bitcoin at $37,000.
Which is steep.
Very. An 80% drop puts the price at $25,000, which actually lines up very closely with a major technical level, the 78.6% Fibonacci retracement at roughly $24,000.
Right.
And then the most extreme models, the ones calling for a full 90% wipeout, have targets of $12,000 to $13,000.
Yeah. And just to give you context on where those targets sit relative to today, the current price is lingering near the absolute shallowest Fibonacci retracement level.
The 38.2%.
Right, the 38.2% retracement, which sits at $56,700. So according to the extreme symmetry models, the pain hasn't even truly begun.
But we need to be crystal clear. For the listener reporting, an extreme $12,000 target isn't the same as endorsing it. We are looking at levels, not predicting the apocalypse. How does the desk treat those 80 to 90% drawdown models?
It's a crucial distinction. The BTG desk treats them strictly as tail risks.
Not the base case.
Absolutely not the base case. They are statistical possibilities, but the desk stops at the visible levels.
The ones we can actually see in the data.
Exactly. The functional analysis stops at that $54,600 magnet and the moving averages. They manage risk around what they can verify with current order book depth, rather than trading on a hypothetical $12,000 doomsday scenario.
Which brings us to the most important part of any institutional thesis, the invalidation. The Q4 crash and rescue narrative is compelling, but, what if the bears are just wrong? We need concrete metrics that would invalidate the bearish roadmap today.
Well, let's start with the simplest one, the chart invalidation. This entire bearish structure breaks if Bitcoin manages to reclaim and hold the 200-period moving average and that broken trend line we discussed at the top of the deep dive.
Reclaiming that shifts the momentum back to the bulls. What about invalidating the macro thesis?
The macro thesis dies if the Fed simply stays on hold.
Yeah.
If the S&P and the NASDAQ hold their June highs and refuse to drop 20%, the Fed feels no pressure.
No crash means no panic cut.
Exactly. And without that liquidity injection, the 2007 analogs just fail to materialize.
We also have a flow invalidation we can track, right? Spot ETF flows.
Yes.
If those flows turn green and stay consistently positive, it tells us that genuine, sustained institutional conviction is returning. But we can also look beneath the surface of the broader market to find strength. This is where the perp strength scanner comes in.
Right, the perp strength scanner, which analyzes perpetual futures contracts. It allows us to see the internal rotation.
Filtering out the noise.
Exactly. It shows us where traders are placing leverage bets on individual assets. And right now, there are genuine bids stepping in.
Give us an example.
Take Moraife, for example. It has reclaimed its 20 and 50-day moving averages and is aggressively pushing the top of its range near $2.10.
Okay, so showing real strength.
Very bullish structure. The invalidation level there is $1.90, but it looks good.
JUP is another one, right? Showing real internal strength. It's sitting above stacked moving averages, trading near 24 cents. But what's really interesting is that it's moving at 1.33 times Bitcoin's beta, meaning it is reacting about 33% more aggressively to upside momentum than Bitcoin itself.
That's significant.
Yeah, and LIT is also on the scanner, building deep volume and positioning while holding a rising 20-day moving average near 13 cents.
But, and this is important, the scanner requires human context because it also flags the traps.
The dead cat bounces.
Exactly. For instance, there's an unnamed asset sitting as the #1 mover on the board today. It is up 60% in 24 hours. If you just sort by daily percentage, you assume it's a massive breakout.
But when you actually zoom out on the chart, that same asset crashed from $3.25 all the way down to $1.10. It is sitting miles below all of its major moving averages. It is the textbook definition of a dead cat bounce.
60% bounce in a downtrend is still a downtrend.
Finding Morpho and JUP showing real strength while the #1 scanner mover is just a dead cat bounce is like finding a genuinely healthy tree versus one that's just painted green. You have to check the roots.
The roots being the market structure.
Exactly. So let's synthesize this. Let's bring it all together for you. We started by asking if the $60,000 bounce is a genuine comeback or a trap, and whether the Fed is coming to the rescue. The most vital takeaway from all this data is that the answer isn't a price level on a chart. The bottom is an event.
That's the key. The bottom happens when the Fed stops promising hawkish rate hikes and starts cutting in the fourth quarter, aligning with the 4-year cycle.
Right. Until Bitcoin reclaims that 200-period line, the $54,600 magnet is the primary gravity.
And as always, we have to remind you of the standard desk disclaimer. These are levels to watch, not buttons to press.
Absolutely. Nothing discussed in this deep dive is financial advice. You have to map your own risk.
The goal is to understand the mechanics so you can prepare.
And on the topic of preparation, I want to leave you with a final thought, a specific what if drawn directly from the desk's caveats. We've built this entire base case around a clean Q4 flush. The S&P drops, the Fed panics, liquidity returns, the cycle bottoms. But what if the 4-year cycle isn't breaking, but stretching.
That is the tail risk that changes everything.
Exactly. If this bounce fails and the cycle elongates, ask yourself, are you prepared for a prolonged, grinding bear market that stretches all the way into 2027, where the honest answer to a bottom is later, not never?
It's a scenario your portfolio has to be hardened against.
Keep an eye on the moving averages and watch the macro calendar. Thanks for joining us on this deep dive.